The average person will spend over a third of their life working to repay debt. Student loans, car payments, credit cards, mortgages. The list never seems to end. Most people believe debt is simply a personal failure, a lack of discipline. But what if debt is not an accident? What if it is the system working exactly as designed? What if the entire global financial architecture depends on you staying in debt? Today, we are going to show you exactly how that system works and why it was built this way. Global household debt currently stands at over $59 trillion worldwide. That number is not a crisis. To the financial system, that number is the product. Banks, governments, and financial institutions are not just tolerating debt, they are dependent on it. Without a constant flow of borrowing and repayment, the modern monetary system would collapse. This is not a conspiracy, it is economics, and it has been built this way for centuries. To understand why, we need to understand how money itself is actually created. Most people assume governments print money and release it into the economy. That is partially true, but it misses the most important part of the story. In the modern financial system, the majority of money is created by private banks, not printed, not mined, created, from debt, at the very moment a loan is approved. When a bank gives you a mortgage, it does not reach into a vault of existing deposits. It types a number into a ledger. That number becomes new money deposited into your account. The Bank of England confirmed this publicly in 2014. Most money is created by banks making loans. This means that for money to exist in the system, someone somewhere must be in debt. When you repay a loan in full, that money is effectively destroyed. It leaves circulation. The system requires new borrowing to replace the money that repayments remove from the economy. This is the core mechanism. Debt does not just fund the system, debt is the system. Now add interest to this picture, and the design becomes even more revealing. Banks create the principal of a loan, but they do not create the money to pay the interest. That interest money must come from somewhere else in the economy, from someone else's debt. This creates a mathematical reality. There will always be more debt than money in existence. Collectively, society can never fully repay all its debt. The system structurally prevents it. To keep the machine running, the total level of debt must always grow, year after year. Central banks call this credit expansion. They manage it with a single powerful tool: interest rates. When the economy slows, central banks lower interest rates to make borrowing cheaper. Cheaper debt encourages people and businesses to borrow more, injecting new money into circulation. When inflation rises too high, rates go up, borrowing slows, money becomes more scarce. The entire economy is managed not through production or labor, but through the price of debt. Now consider what this means for individuals, businesses, and governments around the world. Every actor in the economy is incentivized and often forced to remain a borrower. Governments borrow to fund services because tax revenue alone is structurally insufficient. Corporations borrow to grow, to compete, and to satisfy shareholders demanding constant returns. Individuals borrow for homes, education, and consumption because wages have not kept pace with costs. Each layer of the economy feeds the debt machine, and the machine feeds on all of them.
Let us make this concrete. Consider a young professional in any major city in the world. They graduate university with a student loan. That loan created new money when it was issued. They spend years repaying it with interest, money that flows back to the financial institution. They then take a mortgage, another new creation of money, another decade of repayment with interest. In between, a credit card for emergencies, a car loan, perhaps a personal loan for renovations. At no point did this person make reckless decisions. They followed the script society handed them. Now multiply that one person across hundreds of millions of households globally. The aggregate of all those repayments is the revenue stream that the financial system is built upon. Now consider what happens when people stop borrowing, when a society collectively tries to save. Economists have a term for this. They call it the paradox of thrift. If everyone saves simultaneously, spending falls. Businesses earn less, they hire fewer workers. Unemployment rises, incomes drop. People save even more out of fear. The economy contracts. This happened during the Great Depression of the 1930s. It happened again in 2008 and 2009. Each time, the solution was not to save the economy from debt, it was to inject more of it. Governments borrowed trillions, central banks slashed rates to near zero to encourage more lending. The cure of a debt crisis within this system is almost always more debt. Now, look at the credit card industry as a specific and revealing example of systemic design. Credit card companies do not profit most from people who cannot pay. That creates default risk. They profit most from people who pay just enough, the minimum payment, month after month. A $10,000 balance at 20% interest, paid at minimum, takes over 20 years to clear. The total repaid can be more than 3 times the original amount borrowed. The product was never credit. The product was the perpetual borrower who never fully escapes. The same logic applies at the national level. Look at sovereign debt across the developing world. Nations borrow in dollars from international institutions to fund infrastructure and development. But the interest compounds, the currency weakens, new loans are taken to service old ones. Countries find themselves trapped, not developing, just servicing debt indefinitely. The debt was never meant to liberate them. It was a mechanism of sustained economic dependency. Understanding this system does not mean you can simply opt out of it overnight. Debt is woven into the fabric of modern life. Housing, education, and healthcare all carry a price. But knowledge fundamentally changes your position within any system you cannot immediately leave. The first shift is in perspective. Stop seeing debt as a neutral financial tool available to you. Start seeing it as a product engineered to generate long-term returns for whoever holds your obligation. That reframing changes every decision you make about borrowing, spending, and saving. The second shift is in strategy. Not all debt is designed the same way. Debt that funds an appreciating asset or builds productive capacity is structurally different. Debt that funds consumption, convenience, or depreciating goods is the system's most profitable product. The third shift is collective. Individually, we are consumers of debt. Collectively, we set its demand. Societies that build stronger wages, accessible housing, and public services reduce coerced borrowing. The goal is not to eliminate debt. In this system, that is neither possible nor necessary. The goal is to understand precisely who benefits from yours and to make that choice consciously. The financial system is not broken. For those who designed it, it is working perfectly. The question is whether you are working for the system or the system is finally working for you. That distinction begins not with your income or your assets. It begins with what you understand. And now, you understand a little more than you did before.